Hey there, folks. Ever wonder how corporations, governments, and even your local bakery stay financially accountable? That's where external auditing swoops in, like a financial superhero with slightly less spandex. Think of external auditors as independent watchdogs, sniffing out any financial irregularities or shady dealings. These financial detectives are brought in from outside an organization to provide an unbiased opinion on its financial reporting. Their job? To examine financial records, assess internal controls, and ensure everything is kosher and above board. This independent verification helps build trust and confidence in the financial information presented to the public, investors, and other stakeholders. Essentially, external auditing is all about transparency and accountability. They're like the financial referees, making sure everyone's playing by the rules and the numbers add up. Without external audits, it would be far too easy for companies to cook the books, misrepresent their financial position, and potentially mislead investors and the public. That's why external auditing is a cornerstone of a healthy and transparent financial system. So, the next time you see a company's audited financial statements, you can thank an external auditor for helping keep things honest, or at least for trying their best. All right, let's get down to brass tacks. One of the most crucial aspects of external auditing is the examination of financial statements. These statements, including the balance sheet, income statement, and cash flow statement, are like a company's financial report card. They tell the story of its financial performance and position. External auditors scrutinize these statements with a fine-tooth comb, making sure they are accurate, complete, and presented fairly. They dig into the numbers, verifying transactions, checking supporting documentation, and confirming balances. It's like a financial treasure hunt, but instead of gold, they're looking for errors, omissions, or, heaven forbid, intentional misstatements. Think of it this way. Imagine you're buying a used car. You wouldn't just take the seller's word for it when they say it's in perfect condition, right? You'd probably want a mechanic to give it a once-over, check under the hood, and make sure everything is in working order. That's essentially what external auditors do, but for financial statements. By ensuring the accuracy and reliability of financial statements, external auditors provide investors, creditors, and other stakeholders with the assurance that they are making decisions based on sound information. They help prevent nasty surprises down the road and maintain the integrity of the financial reporting process. So, yeah, financial statements can be a bit dry, but they're kind of a big deal. And external auditors are the ones who make sure they're not just a bunch of cooked-up nonsense. Now, let's talk about internal controls. No, we're not talking about some secret government agency. In the world of auditing, internal controls are the policies, procedures, and systems that organizations put in place to safeguard assets, prevent errors, and ensure the reliability of financial reporting. Think of them as the checks and balances that keep things running smoothly and prevent financial mishaps. External auditors don't just focus on the numbers, they also evaluate the effectiveness of these internal controls. They want to see if these controls are designed and operating effectively to mitigate risks and prevent financial shenanigans. Are there procedures in place to authorize transactions? Are duties segregated to prevent fraud? Are assets properly safeguarded? These are just a few of the questions auditors consider. Imagine a company with lax internal controls. It's like leaving the vault door wide open and hoping for the best. It's an invitation for errors, fraud, and all sorts of financial mayhem. By assessing internal controls, external auditors help organizations identify weaknesses and vulnerabilities in their systems and recommend improvements to strengthen their financial defenses. Strong internal controls are essential for maintaining accurate financial reporting, preventing fraud, and ensuring the efficient operation of an organization. They're like the foundation of a well-built house, providing stability and support. And external auditors are the inspectors, making sure that foundation is solid and up to code. Hold on to your hats, folks, because we're about to dive into the thrilling world of compliance. Okay, maybe it's not as exciting as a high-speed car chase, but it's pretty darn important in the world of auditing. See, businesses don't get to just make up their own rules as they go along. Wouldn't that be chaos? They have to comply with a whole bunch of laws, regulations, and industry standards. We're talking about things like tax laws, financial reporting regulations like those pesky GBRAP principles, and even environmental regulations. External auditors play a key role in making sure companies are playing by the rules. They examine a company's operations and transactions to assess whether they are adhering to all applicable laws and regulations. This involves reviewing contracts, examining tax filings, and testing for compliance with specific industry standards. Failing to comply with these regulations can result in hefty fines, legal troubles, and reputational damage. Nobody wants that, right? So, external auditors help organizations steer clear of these pitfalls by identifying potential compliance issues and recommending corrective actions. They're like the compliance police, making sure everyone is following the rules and staying out of trouble, or at least minimizing the risk of getting caught. Now let's put on our detective hats and talk about risk assessment and fraud detection. External auditors aren't just looking for errors, they're also on the lookout for any signs of fraud. They approach every audit with a healthy dose of professional skepticism, questioning assumptions, digging into inconsistencies, and looking for anything that smells fishy. Risk assessment is a crucial part of this process. Auditors identify potential areas where fraud or errors are more likely to occur and focus their attention on those areas. They consider factors like the complexity of the business, the effectiveness of internal controls, and the overall economic environment. Fraud can be committed by anyone, from low-level employees to top executives. It can involve everything from skimming cash to manipulating financial statements to outright embezzlement. External auditors are trained to identify red flags that may indicate fraudulent activity, such as unusual transactions, unauthorized payments, or inconsistencies in financial data. While external auditors aren't specifically tasked with catching every instance of fraud, their work plays a vital role in deterring it. The mere presence of an external audit can discourage potential fraudsters, knowing that their actions are more likely to be detected. And when fraud is detected, external auditors can help organizations investigate the matter, assess the extent of the damage, and implement measures to prevent future occurrences. All right, let's talk about substantive testing. Don't worry, it's not as scary as it sounds. Basically, it's the process where auditors gather evidence to support the amounts and disclosures in the financial statements. They're not just taking the company's word for it. They're rolling up their sleeves and getting their hands dirty, examining documents, confirming balances, and making sure everything checks out. Substantive procedures can involve a variety of techniques depending on the nature of the audit and the specific risks involved. They might inspect documents, examining invoices, contracts, shipping documents, or other relevant paperwork to verify the occurrence and accuracy of transactions. Sometimes auditors need to see things in action. They might observe inventory counts, watch how cash is handled, or witness the execution of a control procedure. Auditors often reach out to external parties like customers, suppliers, or banks to confirm balances, transactions, or other relevant information. Auditors aren't afraid of a little math. They might recalculate amounts, reconcile data from different sources, or perform analytical procedures to test the reasonableness of financial information. Think of it like baking a cake. You wouldn't just assume the recipe worked perfectly without tasting the batter or checking if the cake is fully cooked, right? Substantive testing is like the auditor's way of tasting the batter and making sure the financial statements are baked to perfection, or at least as close to perfection as possible. By conducting substantive procedures, auditors gather sufficient appropriate audit evidence to form an opinion on the fairness of the financial statements. They're like the fact-checkers of the financial world, making sure everything adds up and the numbers hold water. Now let's talk about something that's crucial in any relationship, whether it's with your significant other, your best friend, or even your auditor communication. Throughout the audit process, auditors are in constant communication with management and those charged with governance. like the board of directors. They discuss the scope of the audit, share their findings, and address any concerns or questions that arise along the way. Effective communication is essential for a successful audit. It helps ensure everyone is on the same page, promotes transparency, and allows for timely resolution of any issues that are identified. Auditors typically communicate their findings in writing through an audit report, which summarizes the scope of the audit, the auditor's opinion on the financial statements, and any significant findings or recommendations. But communication isn't a one-way street. Management and those charged with governance also have a responsibility to communicate effectively with the auditors. They need to provide auditors with access to all relevant information, respond promptly to inquiries, and address any issues raised by the auditors in a timely and appropriate manner. Open and honest communication between auditors and management is like a well-oiled machine, keeping the audit process running smoothly and ensuring that everyone is informed and engaged. It's all about working together to achieve the common goal of reliable and transparent financial reporting. Before auditors even think about putting on their detective hats and diving into a company's financials, they need a plan. And no, we're not talking about a half-baked scheme scribbled on the back of a napkin. A good audit plan is like a meticulously crafted blueprint outlining the entire audit process, from start to finish. Audit planning involves understanding the client's business, identifying potential risks, determining the scope of the audit, and developing an overall strategy for the audit work. It's like planning a road trip. You wouldn't just hop in the car and start driving without knowing your destination, right? You'd map out your route, plan your stops, and maybe even pack some snacks. During the planning phase, auditors gather information, learn about the client's industry, business model, regulatory environment, and internal controls. They identify risks, pinpoint areas where the financial statements are more susceptible to material misstatement, whether due to error or fraud. They determine materiality, establish a threshold for what constitutes a material misstatement, one that could reasonably influence the decisions of users of the financial statements. And they develop an audit approach, outlining the nature, timing, and extent of audit procedures they'll perform to obtain sufficient audit evidence. Just like a good roadmap keeps you from getting lost on a road trip, a well-developed audit plan helps auditors stay on track, allocate resources effectively, and ensure they're addressing the most significant risks. It's all about working smarter, not harder. So, the auditors have finished their work, dusted off their hands, and ridden off into the sunset, right? Not so fast. Even after the audit fieldwork is complete, the work isn't over. The auditors still have to follow up on any findings or issues that were identified during the audit. Remember all those conversations with management, those recommendations for improvements, those potential problems that were flagged? Well, now it's time to circle back and see what actions management has taken to address those issues. This follow-up process is crucial to ensure that the audit has a lasting impact and that the company is taking steps to improve its financial reporting and internal controls. During the follow-up phase, auditors might request documentation, ask for evidence that management has implemented the recommended changes, like updated policies, revised procedures, or evidence of training. They might perform testing in some cases to verify that the implemented controls are operating effectively. And they might reassess risks based on management's responses and the results of follow-up procedures, adjusting their audit approach accordingly. The follow-up process is like the final checkup after a doctor's appointment. It's a chance to make sure the patient, in this case, the company's financial reporting, is on the road to recovery and that any lingering issues are addressed. Last but not least, let's talk about something that's absolutely essential for the entire auditing profession: ethical standards. External auditors are held to a high code of conduct, ensuring their work is of the highest quality, their judgments are unbiased, and their reports are trustworthy. Think of it like the Hippocratic Oath for accountants. Auditors are bound by principles like independence, meaning they must remain free from any influence or bias that could compromise their objectivity. Integrity, they must be honest, straightforward, and act with the highest ethical principles. Objectivity, they must maintain an impartial attitude and avoid any conflicts of interest. Professional competence and due care, they must possess the necessary skills and knowledge to perform their work competently and diligently. And confidentiality, they must protect sensitive client information and not disclose it to unauthorized parties. These ethical standards are the bedrock of the auditing profession, ensuring that auditors act with integrity, maintain their independence, and provide reliable and objective assurance to the public. These standards are enforced by professional accounting bodies and regulatory organizations who monitor auditors and take action against those who violate ethical guidelines. So, there you have it, folks. External auditing might not be the most glamorous profession, but it plays a vital role in maintaining trust and transparency in the financial system. They're the unsung heroes of the financial world, working diligently behind the scenes to keep companies honest and investors informed.